You accepted a $350,000 total compensation package. Your LinkedIn profile reflects it. Your self-worth is anchored to it. And statistically, you are taking home less spendable wealth than your colleague earning a $200,000 base salary with no equity component whatsoever. That is not a paradox. That is arithmetic. Corporate compensation committees engineered this outcome deliberately, systematically, and with institutional precision. The RSU-heavy pay structure was never designed to build your wealth. It was designed to minimize the company's cash outflow, maximize your psychological attachment to a stock price you do not control, and ensure you remain seated at that desk, on their terms, indefinitely. Here is the cold mathematics your recruiter never walked you through. Assume a $350,000 total compensation package, $200,000 base salary, and $150,000 in RSUs vesting annually. On paper, that looks like a $150,000 premium over a pure base salary offer. In practice, it collapses under its own tax architecture the moment those shares hit your account. RSUs are taxed as ordinary income at the exact moment of vesting, not at long-term capital gains rates, not at qualified dividend rates. Ordinary income, at $350,000 of combined W-2 income, you are operating inside the 35% federal bracket in 2026. Your $150,000 RSU vest triggers an immediate federal liability of approximately $52,500. Add your state income tax, assume California at 9.3%, that is another $13,950 gone on vest day. FICA contributions on the base salary portion have already consumed an additional $9,180. Your employer's standard RSU withholding rate is a flat 22% for supplemental income, which means you are already under-withheld on that vest by the difference between 22% and your actual 35% federal rate, a gap that surfaces as a surprise tax bill in April. Net usable cash from your $150,000 RSU vest, approximately $83,550 after combined federal and state obligations. Now compare that against the alternative, a $200,000 pure base salary earner in California. Federal tax on $200,000 lands at approximately $38,800 using 2026 brackets. California state income tax, approximately $13,234. FICA, $9,180. Total take-home, approximately $138,786 annually. Your $350,000 premium package produces $200,000 base take-home of roughly $124,500, plus $83,550 from the RSU vest. Total, approximately $208,050. The delta between your $350,000 package and the $200,000 base salary earner in actual deposited wealth is $69,264. Not $150,000, not even $100,000. That is a 53.8% aberration of your perceived equity premium before you touch a single dollar of lifestyle spending. This is what institutional compensation designers call the liquidity illusion architecture. The mechanism operates on three compounding layers. Layer 1, the blackout period lock. Your shares vest, but corporate trading windows restrict liquidation. During earnings blackout periods, which at most large-cap corporations span 6 to 8 weeks per quarter, you cannot sell. The stock moves, sometimes against you. You have a tax liability that crystallized at vest day pricing, but your actual sale price 4 to 6 weeks later may be materially lower. You paid taxes on a number that no longer exists in your portfolio. Layer 2. The AMT cliff on incentive stock options. If your package includes ISOs rather than RSUs, the structural violence intensifies. ISOs are not taxed at exercise under regular income tax. They are, however, an alternative minimum tax preference item. At $350,000 compensation levels, you are almost certainly inside AMT exposure territory. Exercising $150,000 worth of ISOs can trigger an AMT liability with an effective add-back that strips away deductions you assumed were insulating you. The IRS does not announce this. Your HR portal does not flag this. Your equity plan administrator does not model this. Layer 3. The retention cliff trap. The 4-year vesting schedule with a 1-year cliff is not a compensation vehicle. It is a behavioral containment system. Compensation committees know, with statistical precision derived from workforce attrition modeling, that employees trapped inside a vesting schedule exhibit 73% lower voluntary departure rates in year 2 and 3. Regardless of market alternatives, you are not staying because the role is optimal. You are staying because leaving means forfeiting unvested equity that your brain has already mentally accounted for as current wealth. The equity on your vesting schedule is not your money. It is the company's money being held in your name as leverage. The institutional fix here is not diversification advice. It is a structural timing and entity decision. High-income W-2 earners with RSU-heavy packages should be coordinating vest day liquidation with a tax advisor to ensure supplemental withholding elections are adjusted above the automatic 22% flat rate, specifically requesting additional withholding to match the actual marginal rate exposure, eliminating the April liability gap. This is a mechanics adjustment, executable through your equity plan portal's withholding settings that most employees never touch because HR onboarding never surfaces it. Beyond withholding mechanics, the more durable institutional play involves establishing a solo 401k or a backdoor Roth conversion ladder, funded by the after-tax RSU proceeds in the same calendar year of vesting. This does not reduce the vest day tax event, but it immediately repositions a portion of those proceeds into a tax-advantaged growth vehicle, allowing the post-tax dollars to compound without future ordinary income exposure. The math on compounding $25,000 per year inside a tax-sheltered structure over 15 years, assuming 7% annualized growth, yields approximately $627,000. Outside that structure, the same contributions, taxed annually at 35%, produce approximately $408,000. The structural gap, $219,000 over the same period. That $219,000 difference is the real compensation your equity plan is costing you. By keeping you focused on the gross number rather than the structural execution. Most high learners who run this calculation for the first time experience a specific clinical response. It is not anger, it is the quiet recognition that they have been optimizing for the wrong metric for years, proudly citing total comp in salary negotiations, on anonymous forms, in performance reviews, while the actual deposited wealth has been quietly hemorrhaging inside a system they never audited. The compensation committee ran their numbers precisely. They knew your effective yield. They structured the package accordingly. The question is whether you are now running your numbers with the same precision they ran theirs. Because the gap between $350,000 total compensation and $200,000 base salary isn't $150,000, it is $69,264, and that number gets smaller every year you delay correcting the withholding election. Ignore the AMT exposure and mentally spend equity that hasn't cleared a blackout window yet. The same institutional design logic that engineered your RSU trap is operating at a macro level inside the investment vehicles your post-tax proceeds flow into. The passive index fund, the default destination for vested shares and after-tax savings for virtually every high-income W-2 earner, carries its own structural flaw that compensation committees and fund managers are equally content to let you ignore. Click the video on your screen right now. And let's dissect exactly how the index fund danger compounds the wealth erosion you just calculated. Because the fatal flaw in the just buy the S&P 500 advice doesn't sit where most analysts are looking.